Have you felt it at the gas pump yet? Or maybe seen it in the stock market tickers? Right now, tensions between the United States, Israel, and Iran have suddenly spiked, and the shockwaves are already hitting the global economy. It's a classic case of markets reacting to fear and uncertainty. Even before a single ship is blocked or a supply chain is officially broken, the financial world starts to panic, and we all feel the effects. The most immediate and obvious impact is on oil prices. Why? Because Iran is a major player in the global energy game. All eyes are on one critical choke point, the Strait of Hormuz. This narrow waterway is like the world's oil superhighway. About 20% of all crude oil shipped globally passes through it every single day. If that vital shipping lane gets disrupted, or even just threatened, the entire system feels it. Right now, oil traders are already pricing in that risk. They're betting on the possibility of a worst-case scenario. As a result, benchmark prices like Brent crude are climbing, heading towards $80, maybe even $100 a barrel. So what does that mean for you and me? It means much higher prices for gasoline, diesel, and home heating oil. Basically, energy costs for everyone, everywhere, are set to go up, and it doesn't just stop at your car or your thermostat. This jump in oil prices pours gasoline on the fire of inflation. Think about it. When energy costs rise, the price of almost everything else follows suit. It costs more to transport goods to the grocery store, so your food bill goes up. It costs more for factories to produce things, so that new phone or piece of furniture becomes more expensive. This is happening at a time when central banks, like the Federal Reserve in the U.S., are already in a tough spot. They've been fighting to bring inflation down without tipping the economy into a recession. A sudden oil price shock makes their job exponentially harder. Do they raise interest rates even higher to combat this new inflation, risking a slowdown in economic growth? Or do they let prices run wild? There are no easy answers. For countries that rely heavily on imported oil, including the United States, Europe, China, and Japan, this is particularly bad news. We'd all be looking at higher costs at the pump, which directly eats into household budgets. Businesses would face higher transportation expenses, cutting into their profits and forcing them to pass those costs on to consumers. It creates a vicious cycle of rising prices that can be very difficult to break. Beyond oil, the financial markets are already showing signs of stress. We're seeing a lot of volatility. Stocks, especially in more sensitive sectors, tend to dip as investors get nervous and pull their money out of what they see as riskier assets. Where does that money go? Often it flows into so-called safe havens. Assets like government bonds and gold typically see a surge in demand during times of geopolitical uncertainty. Investors see them as a stable place to park their cash until the storm passes. We might also see the U.S. dollar strengthen, at least in the short term. This is what's known as a flight to safety flow. When global uncertainty rises, investors from around the world often convert their money into dollars because the U.S. economy and its financial system are seen as relatively stable. While a strong dollar might sound good, it can actually create problems for American companies that export goods, as it makes their products more expensive for foreign buyers. These market movements are mostly short-term reactions, driven by emotion and fear rather than long-term economic fundamentals, but they can cause a lot of chaos and uncertainty for investors and businesses alike. Now let's talk about specific industries that are feeling the heat right now. The airline, shipping, and tourism sectors are on the front lines. Any conflict in the Middle East immediately raises concerns about airspace closures. Airlines might have to reroute flights, which means longer travel times and higher fuel consumption. That's a direct hit to their bottom line. For the shipping industry, the threat to a major artery, like the Strait of Hormuz, means insurance premiums for vessels traveling through the region skyrocket. These are called threat premiums, and they add a significant cost to logistics. Some shipping companies might avoid the area altogether, leading to longer, more expensive routes around Africa. All of this disruption increases operational costs and squeezes profitability. For a company that relies on just-in-time manufacturing, a delay of even a few days can shut down an entire production line. Faced with this kind of uncertainty, what do companies do? Many will choose to play it safe. They might cut their growth expectations for the year or postpone major investments in new factories or equipment. When businesses stop investing and expanding, it acts as a brake on the entire economy. It can lead to slower job growth and reduced economic activity, not just in the U.S., but across the globe. It's a domino effect. It starts with a political or military event in one part of the world. That creates fear, which drives up oil prices. Higher oil prices fuel inflation, forcing central banks to make difficult choices. Financial markets become volatile as investors rush to safety, and key industries like transportation and manufacturing face rising costs and logistical nightmares, which can eventually slow down the entire global economic engine. The key takeaway here is how interconnected everything is. A conflict thousands of miles away can directly affect the price you pay for milk, the value of your retirement savings, and the health of the company you work for. While we hope for a swift de-escalation and a return to stability, the economic consequences are already unfolding. The world is watching, and the markets are holding their breath. What happens next in the Middle East will have a ripple effect that touches every corner of the global economy, and it is a stark reminder of how fragile our economic systems can be in the face of geopolitical turmoil. We'll be keeping a close eye on this situation as it develops, so make sure you're subscribed for all the latest updates and analysis. We often hear about conflicts and think of them in terms of headlines and far-off events. But what if I told you that a conflict thousands of miles away could directly impact your wallet, your mortgage, and even your weekly grocery bill? Today, we're diving deep into the hidden economic ripples of geopolitical turmoil, and trust me, it's more connected to your daily life than you might think. Let's start with something we all feel: inflation. When conflicts erupt, especially in energy-rich regions, the first thing that spikes is the price of oil. We see it at the gas pump, right? But the story doesn't end there. Elevated oil prices mean it costs more to transport goods, manufacture products, and even power our homes. This pushes up the price of almost everything, from a carton of milk to a new smartphone. This creates a massive headache for central banks like the U.S. Federal Reserve. Their main job is to keep inflation under control. Just when they think they're winning the fight, a new conflict can send headline inflation creeping back up. What does that mean for you? It means the policymakers who set interest rates might have to keep them higher for longer. Think about it. The interest rate is the foundation for almost every loan you can get. If the Fed keeps rates high, your mortgage payments stay elevated, making it harder to buy a home. The interest on your credit card debt keeps climbing, eating into your budget. For small business owners, getting a loan to expand or even just to manage cash flow becomes more expensive. This chain reaction doesn't just stop at borrowing costs. When people are paying more for their mortgages and credit cards, they have less money left over to spend on other things. They might put off buying a new car, delay a home renovation, or cut back on dining out. This reduction in consumer spending is a major drag on the economy. Businesses see their sales drop. They might freeze hiring or even lay people off, and the whole engine of economic growth starts to slow down. So that conflict on the news? It's directly linked to whether the economy is booming or struggling. Inflation isn't just a number on a chart. It's a real-world force affecting every household. It is the feeling of your stomach dropping a little when you see the total at the grocery checkout. It's the stress of an unexpectedly high electricity bill. It's the tough choice between filling up your gas tank and saving for a family vacation. When geopolitical risk adds fuel to the fire of inflation, it's not just an economic problem, it's a social one, increasing financial pressure on families everywhere. Now let's zoom out and look at the global picture. The world economy runs on a complex network of shipping lanes and supply chains. Key routes, like the Strait of Hormuz in the Middle East, are like major highways for global trade. A huge portion of the world's oil passes through this narrow waterway every single day. What happens if a conflict threatens to close or disrupt a route like this? The immediate effect is chaos. Shipping companies face a nightmare scenario. The cost of insuring a giant cargo ship skyrockets because the risk of attack or damage is so much higher. Freight costs, the price of moving a container from one country to another, can double or even triple overnight. Suddenly, getting goods from a factory in Asia to a store in Europe or America becomes incredibly expensive and uncertain. This isn't just a problem for big shipping companies. It affects businesses of all sizes. A small company that imports unique furniture, for example, suddenly finds its shipping costs have wiped out its profit margins. A larger corporation that relies on components from overseas might have to halt production because its parts are stuck on a ship somewhere, delayed by security concerns. This uncertainty ripples through the entire global trade system. Even if a shipping lane isn't fully closed, the fear and risk associated with it are enough to make businesses change their plans. They might reduce the volume of goods they're shipping or try to find alternative, more expensive routes. This risk premium gets baked into the price of everything that crosses an ocean. The impact is felt across countless industries. Think about petrochemicals, which rely on a steady supply of oil, or airlines, where fuel is one of their biggest expenses. A surge in oil prices can turn a profitable airline into an unprofitable one in a matter of weeks. Even the agriculture sector is affected. The cost of fertilizer, which is often derived from natural gas, goes up. The cost of running farm machinery goes up. All these increased costs eventually get passed on to us, the consumers, in the form of higher food prices. And what about investors? When geopolitical risk is high, the stock market gets nervous. Investors start selling off stocks in sectors they see as vulnerable, like airlines or manufacturing, and move their money into so-called safe haven assets. This is why you often see the price of gold spike during a crisis. People rush to buy it because it is seen as a stable store of value when everything else feels uncertain. They might also buy government bonds or invest in defensive stocks, companies that sell essential goods like food and medicine, which people will buy no matter what. This rotation of capital changes investment patterns. Money flows out of sectors that drive growth and innovation and into assets that are simply about preserving wealth. This can lower economic growth projections for the rest of the year. The optimism that was driving the market just weeks before can evaporate, replaced by caution and fear. To make this all crystal clear, let's look at a real-world example. Take a country like India. It's thousands of miles away from many conflict zones, but it's heavily dependent on imported oil to power its massive economy. When oil prices surge due to a conflict in the Middle East, India feels the pain almost immediately. First, petrol prices at the pump go up, affecting millions of commuters and transportation businesses. This directly fuels inflation across the board. Second, because India is buying more expensive oil, its trade deficit widens. It's spending more foreign currency than it's earning, which can weaken its own currency, the rupee. A weaker rupee makes all other imports more expensive, adding even more inflationary pressure. India's central bank is then forced to react. It might have to raise interest rates to combat inflation and stabilize the currency. But as we discussed, higher interest rates slow down economic growth. So a conflict that started far away has created a difficult balancing act for Indian policymakers and has a direct impact on the financial well-being of its citizens. This shows just how interconnected our world is. A political decision or a military action in one corner of the globe can send economic shockwaves that are felt in households in another. It's a powerful reminder that in the 21st century, there's no such thing as an isolated event. The price of your coffee, the cost of your commute, the health of your retirement fund, all of these are linked in ways we might not always see. So the next time you see a headline about a faraway conflict, remember that it's not just a news story. It's an economic event with real-world consequences that can and will find their way to your doorstep. Understanding these connections is the first step to navigating the complex economic landscape we all live in. Thank you so much for watching. If you found this explanation helpful, Please hit that like button and subscribe for more deep dives into the forces shaping our world. See you in the next video.